Welcome to the InvestTalk Sector Spotlight. I'm Justin Klein.
I'm Luke Guerrero.
And this is a segment that we're going to do regularly. And we're going to do a deeper dive on particular sectors and discuss their both short and long-term trends. Today, we're going to talk about the financial services sector, which is fairly broad. Most people think of financial services, they think of banks, and banks have certainly been in the news, right, Luke, with the banking crisis. And there's a lot of PTSD from '08. Mm-hmm. And that's certainly an important aspect to discuss when you're looking at that subsector. I mean, there's different subsectors of the broader sector. So banking is one that has been top of mind because of Silicon Valley Bank, higher interest rates, duration risk on balance sheets. And I think it's important to do a deep dive because if you're buying abroad, say the XLF, the Spiders Financial Services Sector ETF, you're going to have broad exposure to banks. So the question is, should you have exposure to banks right now?
Yeah, and I think generally speaking, right, the financial services sector is an important one for how the economy is going as a whole, because it is a proxy for the cost of capital, for returns on capital. So yeah, I think it's probably the most important one for us to highlight first.
Yeah, like you said, the lending within the banking sector drives the broad economy. And so if banks are lending sufficiently, the economy will continue to grow. If there are defaults, like there was in '08, like widespread defaults, especially in the mortgage market, and that kind of spread to the rest of the economy. And so what you're seeing right now is kind of the antithesis. There we go. I think I got the word. It's a tough one of that, which is people are paying their mortgages. People are paying their credit cards. There isn't a lot of defaults within the economy. A low level, there's always going to be defaults. That's just the nature of lending. But in this environment, it's not that bad. It's more of the type of other risks that these banks took on, which are duration risk.
Yeah, because every banking crisis is its own crisis, right? It's completely different. The mistakes that you made last year, not the mistakes you're going to make next year. So like you mentioned in 2008, right, the issue was toxic assets. You had a system that had essentially people who were writing loans and mortgages for houses couldn't offload them fast enough because investment banks wanted to buy them and make them into securities. It's called securitizing them and chop them up and sell them. And in essence, you know, if actors act as they should, if they don't act in scummy, partially illegal ways, what ends up happening is you have a situation where a system that has not that much capital has a lot of capital flow into it. More people that want to buy a home can buy a home. It's great. It's a great system. Problem is, though, that's not really how it works. And essentially, you had the situation, like I mentioned, where they couldn't offload them fast enough, and they thought to themselves, well, if these investment banks are going to buy them, that's not going to be on our books as risk. So they stopped doing their due diligence. People got mortgages for $1 million homes they couldn't afford. Big problem. People started using those as collateral to do more investment. All bad throughout the system. Yeah. That's not what happened here, right?
Yeah, exactly. Yeah, this is a kind of the corollary to that, which is we want to buy the safest securities, treasuries, and there are different risks that are involved with buying treasuries, and the main one is duration risk. And when interest rates went up dramatically, suddenly you're stuck with losses, and you have potentially runs on banks, and that's what you saw, and a few of those banks went under. But that's just one part of the financial services sector. There's obviously other parts as well. You can have your non-bank financials, right, that are dealing with things like transactions, right, payment processors, the Visas and MasterCards of the world. And I think that is an area that has its own level of risk, right? The transaction volume within the economy, that certainly is going to impact that part of the market. But also they're taking on some risk sometimes as well. I think of the buy now, pay later environment where they're not necessarily banks, but they are lending, and they're certainly subject to the credit cycle.
Indeed, yeah. But I think, it's important to kind of hint at before we move on a little bit. You mentioned runs on banks, right? And I think that's a really important thing nowadays, because it's not It's a Wonderful Life type world where you went to your old savings and loan with Jimmy Stewart and you stood in line.
It's a lot more complex.
It's a lot more complex, but it's faster.
Yeah.
Because you don't have to get up and you don't have to go to the bank to make a run, and you don't even have to run or even walk or even crawl.
Yeah.
You can do it on your couch from your phone. Yeah. And instantaneously, you have billions of dollars worth of assets that are leaving banks because some VC guy decides to tweet about he's worried that maybe his company should pull out of Silicon Valley Bank, right? And so that's something that's important to note, not just for this sector, but generally, that as the world changes, the risks change as well.
Yeah. Just because finance sounds boring doesn't mean that it changes. It doesn't change, excuse me. Will change with the times. And like you said, you can have a run on the bank from your bed. You can get up in the morning and transfer all of your money out with a few taps of your thumb to a different bank. And suddenly that bank that you left could run into problems. And
and maybe we should talk about a little bit about why there were runs on banks, right? You mentioned interest rates rising. Why don't you talk a little bit about how that's kind of affected where people want to put their deposits?
Yeah, well, people want to put their money into something that's yielding again. For a decade plus, investors were stuck with 0% yielding savings rates because banks had plenty of what are called excess reserves in their balance sheets, meaning they didn't need your deposits. They had plenty of them. And so they didn't need to compete for it. Nowadays, where there are other options, treasuries are yielding once again 5%. You can go buy a short-term treasury at 5% plus. That suddenly is a reason for somebody to say, hey, I don't need to keep my money in this bank. I can go buy a treasury. It's still 100% safe, backed by the government. And now banks are starting to have to compete for deposits once again. And so it's a very different environment that I think the Fed kind of lulled the banks to sleep as well as consumers to sleep, that, hey, we're in a zero interest rate environment. You don't have to think about your cash. Your cash is not going to yield anything. Focus somewhere else. Now the cash yields something. And so that is a new environment that you have to adjust your exposure to banks, and those that could have potential capital flight. Where Silicon Valley Bank, the vast majority of their deposits were non-insured, not FDIC insured, and that's why you had the run on the bank.
Yeah, and I think it's a speed of information thing too, right? Because back in the day, if you're an investor and you wanted to search for yield and you decided to buy treasuries, that's kind of complex. Mm-hmm. But what isn't complex is opening up your wallet on your iPhone and putting it into an Apple savings account that you were just advertised to on Twitter, Instagram, email, text message, carrier pigeon, every way that they possibly could. And it becomes incredibly easy for you to grab that. So
banks need to stay up with the times and invest in technology.
Exactly.
And the banks like JP Morgan, they're the biggest and baddest, and they've kind of done that to a degree. So, the higher interest rates definitely changes the banking sector, but also other sectors as well in the financial services world. One I can think of is insurers, and insurance is very boring business, but different insurers operate in different ways. You obviously have your life insurance companies, and how insurers work, right, is they match their assets with their liabilities. So if you are insuring, if they're insuring some sort of individual, their life, and they think based on their actuary tables, it's 20 years into the future that they're going to pass away, they're going to buy an asset that matures in 20 years. And they're going to have some calculations there. So those life insurers, they're exposed to a lot of duration risk because they're owning those 20-year bonds that they typically will buy that have long duration. Whereas if you're property and casualty insurer, right, insuring your home or your car, the odds of them having to pay out a claim is probably the next few years, right? So they're investing in these short-term instruments, and they're not having to deal with, but they're still getting that nice high new yield that's coming on board on the assets that are maturing. So it's very important to make sure you're understanding the dynamics within the current market and how that's affecting each particular sector. And when the economy evolves over the long term, if the economy is getting weaker, typically banks, anything that's taking credit risk of some type, they tend to not do very well. Like your credit card lenders, right? Your American Express, your Discover, your Capital One, they tend to have higher default rates in a recession. And that's something that most people don't understand. They're looking at the earnings today, but it's not about what the earnings are today. It's about what the earnings are in the next 6 months, the next year. And if you're in a down cycle, down economy, defaults are going to rise, and that means earnings are going to fall.
Yeah. And, it goes back to, again, said it a million times, know what you own. But part of that is knowing what the risks associated with what you own are. And in this situation, you have companies that are involved in completely different lines of businesses, be it banking, where their primary business is lending out deposits, or insurers who their primary business is duration matching of assets and liabilities. And you have widespread changes that are affecting the macroeconomic environment that are Fed interest rates rising, and that affecting different businesses in different ways, but it still permeates throughout the entire industry.
Yeah. And one that I can think of as well is not just the commercial banks, because that's what we were talking mainly about at the start, were commercial banks, but the investment banks. Investment banks, they make their money in multiple ways, but mainly they're helping with M&A activity, right? So if the cost of capital is low, then it's cheap to borrow money and engage in some sort of M&A activity, right? So they make money that way. They also make money by helping companies raise capital. That could be selling equity. It could be selling bonds of some type. And that is something that is cyclical. If the cost of capital goes up, if the Fed raises interest rates, suddenly that can be an issue for those investment banks. So their businesses are very different than your commercial banks.
Yeah,
right?
No, exactly. No, and it's like you mentioned, at the top of this is that there are many different business lines within the financial services sector. And a lot of people are going to look at your JP Morgans and your Wells Fargos and your Citibanks and think that is all the financial services sector is. But so much of the economy, the US economy, is driven by M&A activity of businesses. And like you mentioned, in situations where the cost of capital is becoming more expensive, that is where a lot of people are going to look towards revenue and earnings per share to see how those businesses are doing going forward, because it is a canary in a coal mine, if you will, right? If M&A activity dries up and business investment dries up, that doesn't bode well for the rest of the economy.
Yeah. And that's what the economy is about. It's about activity. It's about transactions. And when the companies are acquired, there are new investments that go into building that business. And it's important to understand how the economy is evolving and how that feeds into the ultimate activity in the financial services sector. So I think we covered a lot of the kind of subsectors. We maybe didn't cover it all, but hopefully give you a quick primer on where we're at within that sector today. And if you want to follow along and see our evolution, because that's really what this is about. It's not about understanding what the sector is today and it's going to stay that way forever. It's going to change. It's going to evolve. And that's what we talk about every day on InvestTalk. So if you want to learn more, just head over to investtalk.com and subscribe.